There's a lot for investors to take in right now, as they mull the implications of the US presidential election, the second lockdown in England, and the imminence of Brexit. But macroeconomic news is actually pretty thin on the ground this week, unless you're an aficionado of interest rate decisions from the Reserve Bank of New Zealand. Governor Graham Orr is expected to leave the headline cash rate unchanged at a record low of 0.25% and leave its quantitative easing unchanged at 100 billion Kiwi dollars. So, not much different from anywhere else, really. A lot closer to home, the most likely headline-making data will come in the form of the latest UK unemployment figures. This number started to creep higher, reaching a 3-year peak of 4.5% in the 3 months to August. That's some 1.5 million people, unfortunately. Now, despite the benefits of the furlough scheme, extended again in light of the second English lockdown, the jobless rate could keep climbing given the fragile nature of the economic recovery and the resilience of the virus. That could also pressure wage growth, which ebbed to a big, fat 0 in August. Even with inflation pretty modest, that's not helpful for consumers' ability to spend either. Two other numbers worth watching in this monthly data set are the Claimant Count. This includes those who are not only unlucky enough to be without work, but those who are on low incomes, who still require government assistance in the form of universal credit. This number hit 2.7 million people in September, having more than doubled since March and the start of the first nationwide lockdown. Second figure to watch is job vacancies. The good news here, and there is some, is that September showed 488,000 job vacancies, up from the record low of around 140,000 in June. The bad news was this was still 40% down in the number of vacancies from a year ago. On the corporate front, the third quarter reporting season is winding down in America, although do keep an eye on Disney and IT bellwether Cisco on the 12th. Meanwhile, on this side of the Atlantic, a good dozen FTSE 100 firms are due to release results, publish a trading update, or host an analysts meeting, while a number of mid and small cap companies are due to do the same. Names which could be of interest include the following: Funeral Services provided Dignity on Monday the 9th of November, Direct Line, Megit, Land Securities, DCC and house builder Persimmon on the 10th, Flutter Entertainment, Great Portland Estates and builder Taylor Wimpey on the 11th, and 3i, ITV, WH Smith, Burberry and another house builder, Vistry, on Thursday the 12th of November. But for me, the company most capable of causing a fuss in the week ahead is National Grid. The utility is due to release its first half results on Thursday the 12th. As you might expect from a utility where demand is usually relatively stable whatever the economic conditions, National Grid shares have been pretty resilient over the past 12 months. They've risen marginally, while the FTSE 100 has fallen by around a quarter over the same time frame. One reason for this relatively steady showing is National Grid's dividend. While over 50 FTSE 100 members have suspended, deferred, cut or even cancelled dividend payments worth around £33 billion this year, the power transmission and distribution specialist increased its total full-year payment by 2.6% for the year to March. That was in line with the dividend policy first laid out back in 2013, namely that National Grid would seek to increase its dividends in line with inflation as benchmarked by the Retail Price Index, or RPI. So the first number to which investors may therefore look in the interim results is the dividend. RPI inflation is currently 1.1%, and last year's interim payment was 16.57p a share, so that's your benchmark for the first half this time around. For the full year, analysts are looking for a total distribution of 49.53 a share, an increase of 2% year on year. That puts the shares in a forward yield of 5.4%, and the forecast payment would be enough to make National Grid the 10th biggest dividend payer in the FTSE 100, if that forecast is met. However, it could be worth digging below the headlines, especially for an income seeker, as National Grid faces its challenges just like any other company. First, the company has flagged that COVID-19 could cost it up to £400 million in the financial year to March 2021. That's due to the potential combination of higher costs, higher bad debt charges for unpaid bills and deferred price increases, with the bulk of all of those referring to the US business. Second, the company is embroiled in a row over gas supply still in New York. And third, the company's Ofgem, the company's regulator, has proposed a much stricter regime than expected for the regulatory cycle that runs from April 2021 for the following 5 years. The regulator wants to cut spending and drive efficiency, point investment towards renewables, and also cut the allowed return on equity in half to just under 4%. In that context, Analysts and investors will look to see if National Grid is changing any of its forward guidance for this year, the last one of this regulatory cycle, especially as it's pushing back very hard on Ofgem's proposals. The key indicators to watch are targeted asset growth of 5 to 7% a year, capital investment of some £5 billion, down from £5.4 billion last year, and an increase in debt of some £3 billion from last year's level of £28.6 billion. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.